gave up managing billions to become a better investor. Episode 7. And over to you, Dr. Freud. Hello. We've talked many times on these podcasts already about psychology, and it is super important. Yes, fundamental analysis really matters. Yes, macroeconomic insights really matter. But psychology it's kind of one of those things which really do impact whether you're a successful investor or not. Because the thing about the investment world is not everything can be easily predicted, certainly by a spreadsheet or reading something in a book or equivalent. I wanted to talk today about how patient you are as an investor. It's kind of interesting. When I started off, particularly when I was an institutional investor, my preferred period was between 9 and 18 months to hold an investment. Now, I remember many people saying, who I worked with at the time, said, wow, that's a very short period of time. We should be thinking about 3 years, 5 years, even possibly longer. But for me, particularly as I managed a slightly more aggressive type of fund, global investments, yes, multi-asset, looking to try to make money rather than just take dividends or be slightly better than the bond market or something like that. I felt that was kind of important. And certainly back then, in the sort of earlier part of this century, the start of the 2010s and related, it was a period of time when lots was happening, sometimes quite quickly. We obviously had the big crisis of the 2007 to 2009 period. And a bit like the sort of the crisis I'd seen earlier in my career, the dot-com bust, I guess the dot-com boom, some issues before that, number of issues after that as well. You know, who can forget the issues in around 2007 to 2009, for example. All of those matters had a big impact on me. And certainly when I was managing institutional monies, particularly in the sort of the 2008 to 2013 period, I felt it was important to actually be that sort of amount of a material active investor. Anyhow, as I've got slightly older, I guess my sort of period of time that I've been considering as being my normal investment zone has kind of it's sort of gone up a little bit. It's reflected the fact that as you get a little bit older, yes, maybe you're harder to sort of impress in investment. And certainly when you are impressed by something, then maybe you're saying, well, actually, I do want to keep this a little bit longer. I think that when I look back to perhaps 15, 20 years ago, and some people were saying to me, wow, these 9 to 18 month periods you were investing in was too little. I think they were missing a little bit of a point there too. Yes, it was good to have these medium-term investments for many, many years. And I had some of those as well. But I also had some shorter-term investments, sometimes for a few weeks, a few months, etc., which when they had hit my target, my sort of aimed for profit, or in some cases, accepted losses and I move on. It was a world that was changing far more quickly. And I feel that if you're comfortable with that sort of backdrop, then when you have market volatility and challenges, it doesn't worry you. It means that you can actually sort of change your allocations quite quickly if required. Not always, but when required, sometimes you've just got to shift and move and change things. So I feel that's kind of from a psychological point of view, very impactful. And certainly when I see the investors I admire, or if you like, the investor which I have become and hopefully keep on maintaining and improving, I feel that's kind of an important insight. I want to share with you a couple of what I think are important kind of quotes for me, at least that have been big and massively influential for me over the years. One was from Isaac Newton. Obviously a very famous gentleman, one of the wisest men probably over the last 500 years, who once observed that he can calculate the movement of stars, but not the madness of men. And that was a reference to actually him losing a lot of money back in the 18th century terms, and certainly in today's terms as well, in the South Sea Company crisis, which is a quite remarkable story, more than a story, a reality that you should certainly learn a bit about if it interests you, when Isaac Newton lost a lot of money after actually making initially a lot of money in his investments there. The other one is something you've probably heard of quite already or before from Franklin Roosevelt, that there is nothing to fear but fear itself. And obviously, he said that during the early days of his presidency, at a time of great crisis in the financial backdrop in the early 1930s. And again, these two quotes are sort of hugely influential for me on the basis that they tell me that there are things that you struggle to predict, hence the Isaac Newton quote, but there are also things that you can always do, or not, if you like, freak yourself out so much to mean that you're unable to do them. Back to the Franklin Roosevelt quote, of being fearful, of not being too fearful, and accepting that sometimes life's tough, but you've got to crack on and do stuff. And it's funny, but when I was thinking about investments, particularly in the early stages of my career, the most impactful, realistic, real, actual investment scenario that occurred for me was from early 1999, and for a period of about 18 months afterwards. So again, it's one of these sort of circa 18-month periods where something actually went very, very well. Unsurprisingly, it was a dot-com stock. I won't mention the name. The company certainly has changed and evolved multiple times since. But I was actually suggested that the share was interested by somebody I knew. And they said, well, you should have a look at this company. It seems quite interesting. They'd already had a holding, bought and sold it a few times, made a little bit of money. And they mentioned it to me. And I had a look. And the share was about £1 at the time. And it did look interesting. Certainly, it was a dot-com company. There was a sort of a technological aspect to it, which seemed quite exciting. They seemed to have some capability there to grow over upcoming years. And it ticked the boxes for me. And so I bought some shares. And the shares actually quite quickly, reflective of that slightly crazy dot-com period at the time, doubled. And it's something that I had sort of thought about before, and certainly I remembered what John Paul Getty, I read his book a number of years beforehand, and he said that the way to get rich is to sell too soon. And it was a quote which he made, and obviously was quite famous for. And I remembered that quote, and the share got to £2, and I thought, I know what I'm going to do. I'm going to take my capital out. I'm going to sell half my holding so that even if this turns out to be a terrible call in all following moments and the company has a huge problem and basically the shares go to almost zero at some point over the next year or two, at least I take my money out. At least I'm not going to lose anything on this trade. So I took half my money out and I ran the rest. And I felt that was a sort of a wise or a good thing to do. And funnily enough, the shares over the following sort of 6 or 9 months, as we reached the crescendo of the dot-com period, the shares went from the then £2, from my original £1, it went up to well over £30. And certainly when I look back across the rest of my investment career, I never had another stock do anything like that for me. It was a remarkable backdrop. In terms of what I did, I'd sold another half of the shares of my continuing holding when it was, I forget whether it was 32 or 34 pounds, something like that. And then as the dot-com boom turned slowly into the dot-com bust, I realized that something was awry, and I sold the rest, in fact, the finale, all of the remaining shares, as something around the lines of 18 or 19 pounds. So it was a remarkably wonderful investment for me, a real one-off. I've never had anything even akin to that, and my guess is probably never will, just because I've kind of probably wouldn't be investing in that type of company going forward. I would look for something a little bit more stable, which still maybe offers great potential, but maybe not of that sort of proportional magnitude. But anyway, what was interesting was that my contact, the person who actually told me about the company or said, have a look at this one initially, was a little bit more of a trader than me, whilst I had that sort of 9 to 18 month kind of time perspective. And as you see, I'd already kind of sold the share 3 times ultimately at various stages of my investment. You know, I wasn't shy to change my shareholding. My contact had actually been in and out of the share a number of times and admitted to me when the company was actually back below that £18-90 level. I think it ultimately ended up back at the £1 level. It did the whole complete route. He admitted at that point that he'd made basically a loss on the share, unbelievably, and had probably traded it 4 or 5 times as many as I had done, but had actually made the wrong calls at the wrong time. Even though he'd made initial good investment, a bit like Sir Isaac Newton, he'd ultimately ended up losing money on it because I think he had got a bit greedy and had put too much money in when it felt comfortable to do so, or when it felt as if there was such great confidence that this company was going to be wonderful. And of course, for those of you who've heard of cryptocurrencies and related, I guess there's something similar to that, isn't there? I'm not clever enough to invest in cryptocurrency. I've talked in a previous podcast about my preference for gold and my solid success with that, and my perception of how that fits into a portfolio on my previous podcast. But it's kind of interesting about crypto, where you've had people who've made a huge amount of money, the very early investors, but the vast majority of investors, of course, have been those who have made crypto investments over the last few years and have lost money because of the fall of the crypto, various price Bitcoin and related over the last couple of years or so. And that's often the way with investments. And we talked before about how it's important to know better than 90% of the market. And even though that sounds crazy and difficult, believe me, it isn't. But if you can do that, then when you see confidence for a particular share becoming apparent in, let's say, 50% of the market or 60% of the market, because you've been in that sort of still early-ish, not the first person to invest in it, but one of the earlier people to invest in it, a bit like what we've seen with those early-ish crypto investors from, I guess, 10, 15 years ago, who did very well, irrespective if they've taken losses over the last couple of years. They've still made a marvelous return. And I think that's the thing about investments. It's understanding when to play the investment game, when to get involved, when to agree with your insights and your research and the macro backdrop, and when not to. And that's where it comes, for me, a fascinating, interesting, deeply intellectual game. One where psychology, as we've already observed, does play a very big role. It's not just about stuff that you can read in investment books or even by talking to companies or listening to their conference calls and related. Psychology matters hugely. You are only, after all, just one player in the broader global investment markets. Even the biggest investor can only have so much influence, and certainly any individual, any private investor, even any small institutional investor, believe me, can only have some small element to anything. Anyway, I wanted to sort of move on from that into, before we talk about I was going to talk about sword of Damocles and sort of challenges to when you have things going wrong and, oh my goodness, what should I do? Because that's kind of something which is deeply impactful upon any investor. And believe me, as I've said before in these various podcast episodes, I've made plenty of mistakes. We'll talk about some of those in a few moments' time. But generally, you still make many mistakes as an investor. If you can get better than a 5 out of 10 rating on your investment choices, then believe me, you're doing great and you will make money as an investor. But that's the reality. Nobody will ever be anything above an 8 out of 10 investor. Even the best investors in the world, at best, and believe me, they're not consistently best or brilliant, will be 7, 8 out of 10 investors. But if you can be a 5 out of 10 investor and be sensible and actually be fearful when others are greedy and greedy when others are fearful and all of that sort of stuff, do all your research, macro, underlying, micro, sector, stock specific, bring it all together, keep on writing down notes and related. Believe me, even a 5 out of 10 investor can make decent money and decent returns for their portfolios. It's just a question of desire and application, really. Anyhow, I thought I'd talk to you about a sort of a couple of related issues. One of which is, so when do you cut an investment? I've talked about one which went well. Let's talk about some that didn't go well or went wrong. What do you do then? And my kind of feeling is that you should always initially, I know some people say it's very important to have a stop loss. And I can understand that, you've made an investment at 100 pence, let's say. You say, right, if the share price falls below 90 pence, then I'm out, irrespective. It's been a wrong call. I've lost 10%. I'll accept that and move on. Or maybe it's 80 pence. You've lost 20%, whatever your particular figure is, whatever your profile is, the time space you're talking about and related. I think that's fine. However, my view would always be, instead of having a stop loss, I would have a double or quits kind of view on it, i.e. be it below 10% or below 20% or whatever your figure is, you should say, okay, at this point, it's a double or quits. Am I still believing that this company is great? Everything is good. It's undervalued. My macro and sector stock work is still suggesting it's cheap. If so, then double up. Believe me, as Sir Isaac Newton found out, there's plenty of crazy things that go on in the world of investment from other investors, but maybe you've spotted something most people have not. Or maybe they've spotted something, of course, that you haven't, and you have to accept that. So believe me, that double or quits kind of moment is important. The worst thing an investor can do is make an initial investment and then just let it slide. Because that's just telling me it's like you're embarrassed that it's fallen by 10, 20, 25%, whatever it might be. And it's like, oh, it's embarrassing. When I look at it, I see the loss there. What do I do? Look at it afresh each time. Each time there's a results period, each time it hit a level, it hits a particular important level for you, an important loss level. And you say, okay, what am I going to do? Am I going to double or quit? Believe me, this is where results season and earnings season is super important, because that is where you get so much insight into whether a company is cheap or not, rather than just saying, oh, I'm reacting to what the share price is on the stock market. As I've talked about before, if you're a technical investor, which is absolutely fine, but if you are predominantly a technical investor, this is not really the right sort of podcast for you. This is a little bit more centered on psychology, fundamental matters, macroeconomics and related. It's not centered on technical investing. So remember that. Think about the double or quits insight, and this is where all of these other macro, micro and related issues become apparent. I was going to talk to you about three insights I gained from my first job when I was working in the hedge fund research industry. And one person, I'll give you three stories, one which went very well, one which went quite well, and one which went quite badly, well, in fact, very badly. So to give you the sort of full insight to it all. The first one, which went very well, it's actually probably the most famous, not for anything I did, but for the gentleman who was I'm going to talk about, and that's Bernie Madoff. Bernie Madoff was a fairly famous, fairly well-known hedge fund investor who managed a fund which attracted a lot of capital, until, unfortunately, it turned out to be effectively a Ponzi scheme, a fraud. And it's funny, the company I worked for, the company A, at the early stage of my career, many, many years ago, had an investment in Bernie Madoff ultimately managed products. And we thought, you may recall from a previous podcast, that my boss and I went to New York to meet hedge fund managers, and it was a great, hugely insightful manner for me to start my investment career. And afterward, I'd certainly been 2 or 3 times. We'd never had the opportunity to meet Bernie Madoff, and so we made an application to meet with him, and a few sort of insights or answers came back. We could meet with him, but it could only be, if I recall, it could only be on a Tuesday. That was fine. If that was a particular day that suited his schedule, no problem at all. It would have to be after markets. Well, that's kind of understandable, because I can understand that people are busy during market hours and perhaps a little less busy after market hours. That was okay. It would be at the coffee shop just below where his office was located. He'd have a coffee, and you could talk about anything except the fund. And that was just bizarre. I mean, really, I can understand just about somebody wanting to meet in a coffee shop. I mean, it sounds a bit strange. Normally you would meet at an office, or at least have a look at the office. And if they said, do you want to go for a drink? Do you want to go for dinner or something? Fine. But you at least see the office to know that it exists. But you could talk about anything but not about the fund. I mean, that is just bizarre. I mean, whilst it's always nice to talk about people about many other things, politics or, anything, football or whatever it might be, you should really be predominantly talking about what you're there for, which is investment and related matters. And my boss and I decided that despite the very good performance at that time, the high confidence people had, the low volatility and all of those sorts of things, we were going to sell. And it was a bit of not that we were a particularly big or influential investor. We owned something, a good amount of clients' money, but we sold out. I remember a couple of clients actually withdrew their money from our funds because they said, hang on, we don't get it. This looks like a great investor. Why are you selling? And we said, well, we have no ability to get any confidence in this investor, sadly. And consequently, we felt the right thing to do was to sell. Many, many, many years later, and we're talking well over, somewhere between 5 and 10 years later, if I think about it long enough, I'll remember the exact number of years, but many years later, it turned out that Madoff, as I said, his fund was a Ponzi scheme, it was a fraud, and investors that were still there at that moment in time lost, basically all of their money, or at least a very large proportion of their money. Again, it tells you, if something is too good to be true, too good to be heard, or at least giving you that sort of funny feeling of there's something wrong here, but I can't put my finger on it. The numbers look good, but I just don't trust it. Then please take your instinct fully and say, I don't trust it. I'm happy to leave it to others and sell it. Always have confidence in your insights on all of this. Research and related matters always hugely. Forget what the numbers alone are telling you. Think about what your body, your gut feel is saying to you in terms of whether you can trust this or not. Because let's face it, what's the numbers that have gone, they've gone. What matters now for you as an investor is what's going to occur going forward. That's all that can have any future impact on you. Second one was with two brothers. Again, they were down in the southern part of New York, and kind of fascinating meeting. I think it lasted about 4 hours. They at least allowed us, it was after market hours, which is fair enough. They did allow us into their office, which was good. It's perfectly normal, a little bit small, but perfectly normal sort of office. But what we didn't understand here, again, it was a company with a brilliant track record, very nice numbers, not particularly volatile, good returns, etc., etc. Ticks all the boxes. The difference was that, again, when we went into detailed investigation about the firm, into their strategy, into how they were making the money, the risks they were out there and whatever, just there were some bad feelings about it. It just felt worrisome. There were questions that weren't clearly answered, or at least in ways which didn't satisfy us sufficiently. We again sold out of that fund, and again there was a little bit of criticism from underlying clients because all they'd seen was a fund which had performed very well for a lengthy period of time. But again, it was the wise thing to do because it just didn't feel right to hold it. As it happened with this one, a number of years later, there was a bout of volatility, much higher volatility than what they'd seen previously. And even though the company did carry on and didn't lose investors a large chunk of their money, I think it certainly told a lot of investors who were still with the fund at that time that actually that volatility was not quite as attractive. That profile was not quite as attractive as what they'd been hoping and seeing in the previous 4, 5, 6, 7 years. So again, keep on researching, keep on drawing on those insights. The one that was the mistake, the one which turned out poorly, was a gentleman called Michael Berger. There's a hedge fund called Manhattan. He was again, we had a number of meetings there. Myself, my boss, other people related with the business. Everyone was very impressed. Very high reputation, good investment record, not a fantastic, oh my goodness, this is marvelous, but a different. He was certainly somebody who fitted in well because managing a fund which was performing at a different time. It's often short of the market rather than long, and therefore the advantage of that, of course, is that when the market falls or has volatility, that can be a helpful strategy to have across your whole portfolio. And so certainly what we found was that fitted in very well with some other allocations that we had. Now, unfortunately, he was a fraud. He actually had been lying about his numbers, basically defrauding some of the people that were associated with his business, in terms of doing his accounts, and related other people had not seen the problems, and all the numbers published were incorrect. That was a tricky one, because unfortunately we really should have spotted that. And that's where research, I certainly learned something from all of that. You can do a lot of research, but there's always more you can do. And there's always research you can carry on doing, despite the fact you think that you know something because you've been invested in it for a long time. There's always more that you can find out of an investment. So anyway, that was one in my early career that I lost out on. Of course, there have been plenty of other investments I haven't made money on in subsequent years and the following couple of decades or so, and no doubt in the next couple of decades too. But at least always I'm trying to learn, trying to feel insights that I've gained and trying to apply them to become a better investor. And believe me, irrespective of how old you are or how experienced or not that you are, believe me, you can always become a better investor. And that's what's exciting about this world, I think. That's what's exciting about the investment matters. You can always get better. Anyway, I hope that's helpful. It's again showing you that kind of psychological impact is super important. And even when you get an investment wrong, just think, so did Sir Isaac Newton. And if you remember that, then you won't probably feel quite so worrisome about it. Anyway, once again, I've probably told you so little, and once again, I must close. But hopefully, episode 7 has been of insight. The next episode is going to be called, Can You Have Too Much of a Good Thing? Thank you very much for listening, and bye-bye.